Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia. Today, our webinar title is Bond Market Outlook for the second half of 2024, the route ahead for fixed income. My name is Shen Chu. I'm the moderator for this session. Now, the world has come to a pivotal time where the Federal Reserve is getting ready to move this September, okay, in cutting the interest rate. So what does it mean for the bond market? So that's what we're going to find out in this session. So before we begin, as usual, disclaimer, whatever we share in this session is only for educational purpose. So in no way that I give any recommendation for you to buy or sell any listed products that we mentioned here. If you decide to make any investment decision, you're 100% responsible for all your investment risk. Now, today, we are very honored to invited the Chief Investment Officer of Fixed Income from RHB Asset Management Malaysia to conduct this session for us. Now, he's a CIO of Fixed Income of RHB Asset Management in Berhad, and he has more than 23 years of fund management experience, specializing in fixed income investment for insurers and asset management companies. So prior to joining RHB AM, he was with MCIS Insurance Berhad for 8 years, managing both life and general insurance portfolios. As CIO of Fixed Income, his primary role is to set the strategic direction for the fixed income investment team in Malaysia and RHBAM's regional officers covering both senior portfolio managers and credit analysts. So his strong investment acumen is recognized by the market, and he has been awarded as the most astute investors in Asian local currency bonds for Malaysia, ranked #1 by the Asset Benchmark Research for 4 consecutive years from 2014 to 2017. And he continued as top 10 and highly commended rankings for the most astute investors in 2018 and 2019. So he is none other than Mr. Michael Chang from RHB Asset Management. Right, Michael, very pleasure to have you here today. How are
Hey
you?
Shane, thank you so much for the great introduction, and also good evening everyone, and thanks for having me. A special thanks to Bursa Malaysia for allowing to participate in this webinar, and for the rest of the audience, thanks so much for spending time, your precious evening, to dial up to this event on the bond market. So
Cool.
yeah, cool.
I will just stop sharing my screen and hand over the screen control to you.
All right, great. Thank you so much. Let me just go and share our slides for today. So I hope everyone had their dinner, and then hope this will be a very interesting session on bonds for everyone. So bond market outlook for second half of 2024, the road ahead for fixed income, presented to you by my firm, RHB Asset Management in Berhad, in collaboration with Bursa Malaysia today. So Shane has already done a very detailed introduction of me. I'm the Chief Investment Officer for RHB Asset Management, looking at fixed income. So the agenda for today will be looking at US interest rate outlook. Rate cut is no longer an if, because everyone knows that the US will be on an easing path in terms of US interest rates. What are the implications in terms of investments, fixed income in a rate cut scenario in the coming months ahead? And then in terms of Malaysian fixed income outlook for the second half of 2024. And then, of course, also fixed income as a key diversifier in terms of your investment portfolio. So I would just like to start off with the sense that US interest rate outlook, rate cut is no longer an if for the US markets, simply because I think they are already showing some signs of pivot in terms of economic numbers, as well as also job numbers. So in terms of US inflation, it has actually moderated, and unemployment is starting to on a rise in terms of unemployment numbers. So monthly, in terms of the US inflation, which is actually consistent with the Fed in terms of addressing inflation, is to made inflation around 2% of its target. So naturally, in terms of the July numbers, CPI is actually approaching at 2.06% on an annualized basis and plus 0.17% month on month. So it's clearly that in terms of the rate hiking that US Fed has actually embarked on since 2021, 2022, and the steepest increase in terms of interest rates has been in 2022, all the way to where it is right now, which is 5.25%. So all in, I think you have actually seen the US has actually been very aggressive in terms of raising interest rates. And simply because I think inflation was a little bit on the higher end of the range that the US is comfortable with, and also because of COVID supply disruptions that has led to inflation being at such a high level. In addition to inflation, I think we also saw the unemployment rate is also steadily increasing over the number of months. So we've actually seen that previous job gains that has been in the other months has also been revised. In terms of the unemployment, it's actually going a little bit higher from here, and that's also why, in general, why are we actually going into a change in terms of economic landscape for the US. And that is also why the futures market in terms of the US has also priced in for Fed to cut rates. So market was actually quite quick to actually price in Fed cuts amid all the economic weaknesses. Although market was a little bit more aggressive in terms of pricing of rate cuts compared to what the Fed has guided. But I think usually markets will tend to act ahead instead of being slow in that process of going into a high interest rate environment. So there has been a sharp decline in terms of some riskier assets. I think last month itself, where we actually saw Japanese markets actually selling off early in August 2024, where it also triggered the expectations of a bigger cut, although expectations have since moderated. I think you can remember sometime in August, there was in one Monday, you actually saw Asian markets corrected in a very big manner. And that one started with of course, the magnitude was actually more pronounced in the Japanese market. So in terms of rate cut expectations, market is actually thinking that the Fed will cut 25 basis points in the coming September meeting in this month itself for the US. And potentially there are also some market participants actually looking at potentially 50 basis point rate cut. But I think in terms of smoothing out the expectations of market, the Fed will actually be looking at a 25 basis point rate cut, just to actually guide the market that US economy is not as as bad as what it is. So the base case expectation is for US to cut 25 basis point in September's FOMC meeting. By year end, I think market is also pricing the Fed to cut between 75 to 100 basis points by year end. With 3 meetings left for year end, the expectations is 25 in each of these meetings. That will be in September, November, and December. Unless one of these meetings has an additional 50 basis points cut, then that will actually bring the whole cut for this year to be 100 basis points. So the bond market, I would like to caution here, also may overprice the magnitude of rate cuts for 2024. With that being the risk, there's also this risk of yields spiking back up if the actual decrease in US Fed funds rate is lesser than expected. Excuse me. So current data actually allows the Fed to be, a bit more patient in terms of systematically reducing interest rates. The rise in unemployment was largely due to more people looking for a job. Essentially, you can see it here in the chart on the left-hand side, where you actually see the unemployment U.S. labor force versus the unemployment. So this black line has actually showed there's a spike in terms of unemployment rate. That's also why Fed is also taking charge in terms of going on this pivot of lowering interest rates to ensure that it will cushion the impact of the rise in unemployment numbers. So in terms of the ratio of unemployed versus job openings, still below 1, i.e. jobs are still more than unemployed person. But I think overall what the Fed actually concentrates on is more of the unemployment number, unemployment rate going ahead, and what is the expectation within the next 12 months in terms of unemployment. In terms of US retail sales, I think we're still seeing above 2% in July. It also means that in terms of the US economy, while it's going to a phase of a bit more moderation in terms of demand and retail sales, generally is not in a very panic mode per se in terms of labor market. That means there's still spending in the US economy, which actually drives a little bit on the consumption story. But having said, I think but pressure is building up. So to the Fed, I think previous cycles suggest that very fast increases in unemployment can actually be one of the surprise. So economic data, because they are historical, there's also a tendency of being a laggard. So in terms of the Fed to actually look into a rate cut is sort of imminent in September, so that they won't be fault on being too late in terms of acting towards the economy when things are slowing down a bit more. So actually, who decides in terms of the FOMC? You can see here that there are 12 members in the FOMC committee who actually vote on the Fed decision in September 2024. And of course, the most popular and everyone is looking at is what is Jerome Powell's take in terms of guiding the markets, as well as where is the US economy heading from here. So I think this is also something that was also widely covered in terms of the Jackson Hole Symposium that was held on a week ago on the 24th to 26th August 2024. It's one of the longest standing central banking conferences in the world, where it actually brought together economists, financial market participants, academics, US government representatives, and news media. The message was actually quite clear that US is actually ready into cutting interest rates in September. So in terms of what is the investment implication if we are looking at rate cut scenario, definitely the beneficiary of this potential rate cut will obviously be the most sensitive to price increases. That would be fixed income. So in a scenario where we're going to see rate cut expectations building there, I think there's actually still quite a lot of opportunities in the bond space. US bonds has also been in terms of yield, relatively where we started the year and now, although yields has come off, but it's still on a very much higher yield position compared to previous years, in the sense that in a typical yield environment, currently because of the official interest rates is still very high for US, that has actually made US yields somewhat attractive compared to historical standards. US real rate is also high, suggesting there's actually room for the Fed to cut interest rates. US real rate right now is 2.6%, essentially looking at using the interest rate, the nominal interest rate, compared to the current levels of inflation. So plus 2.6% in US real rate means positive means you have a cushion or buffer to actually cut interest rates to actually stimulate the economy. Typically, the long-term average for US real rate is about -1%. So clearly at 2.6%, it does give them ample room that they can actually reduce interest rates. So given that buffer in terms of real interest rates, we believe that Fed will actually take the they take the opportunity to do so in the earliest September meeting. So in terms of the asset class, fixed income does well after Fed has actually peaked in terms of its interest rates. And within fixed income, you can actually see these are the categories of assets that's within fixed income. And generally, these are the ones, the asset class that will benefit significantly from a rate cut, comprising of investment grade corporate, core plus, investment grade, municipal, multi-sector, short-term, and the 3-month T-bills. Most sensitive to all usually would be the short-term rates because they will be the one that will adjust quite significantly when there's a rate cut. But of course, there's also risk to the outlook in the sense that US politics may swing the positive momentum for fixed income. Essentially, this is also something that we will be watching very closely in the month of November. Who will be the next president for the US? Current running, in terms of who will be the next president? It will be Kamala Harris and also Donald Trump. So these are some of the indicators that we're seeing, and definitely at this point, Kamala Harris has actually been running on the leading pack. Red wave is also a key race where President Trump wins, and then the Republican also, you can actually see possibly the sweep in terms of the House and the Senate. Potential key policies that could be implemented by Donald Trump in a rate wave scenario would be larger fiscal spending, increased tariff on China. 60% of universal tariff could be also one of the question marks. Tax cut version 2, more immigration control, and change in foreign policies, example, towards US treatment for Ukraine or Taiwan. Definitely, if there's a larger fiscal spending, which means that US incurs more debt, then there's also this potential risk that yields could go higher because when you have larger supply of debt coming into the fixed income market, it also means that investors can actually wait and see when they want to enter into the bond market. They may want to look at yields that are actually more attractive before they go into picking up bonds. But generally, in an environment where you actually see some yield reversals where yield actually goes up, it's actually an opportunity for investors to look into investing, because then it becomes when you're accumulating fixed income assets, it becomes cheaper and overall will actually give a better risk reward to investors when bonds actually become cheaper. I mean, in most years, most of the time, fixed income is generally quite expensive. Only in recent years, when we have collectively an increase of interest rates by all central banks, including the developed markets and the emerging markets, that's when we actually see fixed income being more appealing, because you get to actually invest in bonds at a much cheaper entry compared to previous historical prices. So having said what's in stock for the US, coming back to Malaysia, you can actually see that overall, yields have actually seen a reduction in yields, and especially so if you actually have been looking into the corporate bond market. We have actually seen the returns for local fixed income outperforming, especially in the corporate bond segment, because corporate bond yields, they tend to trade on spreads, and currently at this juncture, we are actually at the historical tightness in terms of spreads. Spreads typically means how much of additional return that you want to demand for holding corporates on top of your risk-free, which is your government bond. So we have actually seen a large compression in terms of spreads that's in the local bond market. And we think that currently the spread is actually at a record tight level. Of course, where do you make money from here? So essentially, if let's say if you want to make money from this current tight market, then you have to go into the most sensitive asset class, which is the government securities market, where you actually have a direct impact if there's rate cuts, whether is it triggered by the US or in some sense regional central banks that is within this region that starts to cut rates. We have actually seen this happening in the Philippines, where they have also started to ease off rates. And I think, when Fed starts to actually go on a more dovish pivot, meaning to say that from a rate increase to a rate decrease, you can actually see other central banks also having a breather, and they will also look into cutting rates to support their respective economies. So what's the outlook for second half of 2024? Overall, the Malaysian fixed income market is still bullish, primarily driven by three confluence of factors. Improving sentiments. Foreign investors are also starting to actually look into acquiring Malaysian assets. We've actually seen this in the equities market, where year-to-date equity markets has actually registered a 15% gain in terms of where the CI is. And from bond market perspective, we have actually seen also foreign investors' portfolio flows coming into Malaysia because of two things. They look at the currency and then also the interest rates. So in the dovish pivot for the US, generally the flows for fixed income, especially emerging markets, of which Malaysia is one of them, will tend to see prices of government bonds to lead the price increase. Also, because why has also been an important asset class for local bonds is because we also have a very high local savings rate. In fact, when you actually see most of the primary issuances in the market, it tends to oversubscribe, whether they are coming from institutional demand or whether they are coming from private individuals or high net worth individuals that want to get a piece of this market via block deals or via their private bankers to ensure that they get an allocation in terms of fixed income asset to give them a constant stream of income into their investment strategy. So in terms of US rate cut, definitely it would be the main factor as well, where we actually see EM, emerging market, and Malaysia being one of them to benefit from this trade. And then Malaysia has also been very disciplined in terms of its fiscal consolidation, where we actually looking at lower than 3% fiscal deficit, less than 60% of federal debt, and also less than 25% of financial guarantee. So the round of fiscal consolidation that has been demonstrated by the Malaysian government has also made that appeal to be more attractive to foreign investors. If foreign investors, especially fixed income global investors, if these are all the macro factors that they look at, fiscal consolidation, lowering of debt, supported by consistent growth in terms of GDP, and then moderate inflation in the market that we're actually seeing overall manageable inflation, that will actually attract portfolio investors into bonds. And that's also when fixed income become an attractive asset class. So jumping a little bit into what does bonds or what does fixed income mean? Generally, it is a position of a key diversifier in one's asset allocation or one's investment strategy. The benefit here in fixed income is it provides a consistent stream of income. Essentially, it's the interest payments that as a fixed income investors always obtained every 6 months. Bonds typically pay coupons or profit in the sense of sukuk every 6 months to the investors. And then, of course, at the end of the maturity, the full principal and amount will also be returned back to the investors. Constant stream of income, and then followed by a return of capital at the end of the bond maturity. So it's extremely important to also have fixed income in a portfolio because you want to be as diversified as possible in terms of a investment strategy. And we cannot actually underestimate the income factor, income generation factor of bonds in one's portfolio. You may have some in equities, you may have some in cash, gold, but fixed income will always be the enabler in terms of getting income streams. So whether you're buying conventional bonds or sukuk, I think the attractiveness of the fixed income as a tool is the consistent income stream that you receive from coupon or profit from various sources. It could be from government bonds, it could be also be from corporates, and also asset-backed securities. But of course, all these will need to be assessed, especially if you are in corporate bonds or anything that does with credit. There needs to be careful consideration in terms of credit, because if you are actually taking the expectations that you get your principal back at the end of its maturity. So all assessments in terms of corporate bonds has to include credit as a big chunk of the risk, because you also need to ensure that the borrower or the issuer actually pays you the principal at the end of the maturity on top of the constant stream of income that you get every 6 months. So some of the investors, which actually goes on a very safe investments, then they typically look at rated bonds that are A and above, and these are typically what is in the Malaysian fixed income market. In the overseas or more developed market where they have more riskier bonds, we call them investment grade BBB bonds or high yield bonds. These are the ones investors where they have a more appetite for risk, and that's where they also get rewarded for the risk that they take with a higher yield potential. Some are even also in perpetuals in terms of fixed income universe, where they also take whether they're thinking bank perps or corporate perpetuals. So all these has to be looked at in a more systematic manner in terms of credit analysis. How much of this investments do you understand in terms of its credit profile? There's a lot of work in terms of assessing, and investors has to be clear on how do we go about in investments in bonds. Bonds can be a bit boring, but having said that, there's still potential capital appreciation if you are in a cutting interest rate environment. Essentially, the bonds that you hold, because you are locking at a much higher yield, it actually becomes more attractive when there's a cut in terms of interest rates. So, when there's a shift, when riskier assets, for example, equity markets doesn't do that well, that's also when investors actually look into bonds. And that's also where we actually see capital appreciation in bonds in the form of increase in prices of bonds. So typically bonds that are issued at par, when there's a rise in, there's a demand for it. And also when yields goes lower, because yield and price movements for bonds are inverse related. When we actually see yields going lower, it actually translate to higher bond prices, and that's also when you actually make capital gains from bonds. Compared to riskier assets, bonds also exhibit lower volatility because of the duration and then also the income that the fixed income assets do provide. So generally, the returns are actually more stable, and that will actually reduce the low volatility of one investment portfolio. And bonds also have a fixed maturity. So as I mentioned, at the end of the maturity, you should be actually see more, a payment of one lump sum towards the investment of bonds. Okay, in terms of some of the returns that we've seen in terms of bond funds for the past 5 years, generally bonds have actually generated, in general for the past 5 years, given there's also a run up in for the past 2 years in 2023 and also year-to-date 2024. Past 5 years, we are looking at the total return about 22.39%. Which also means that in the past 5 years, if you have held bond funds, you can also see that total return at par with what was in the equity market as well. So it's also something that we also need to be aware that actually slow and steady investments also has its relevance, especially in a market where there are years when they cut interest rates. So when there's no cut interest rates, you typically get the income from bond investments. But when there's a cut in official interest rates, whether it's in Malaysia or whether it's in the US, you actually get additional return in the form of capital gain. So as I mentioned, also bonds act as a asset that has a lower volatility. And then in terms of it's also, as a diversifier from riskier assets for like equities, because when equity market doesn't do well, that's also when bonds actually gives you that return, albeit at a much smaller capital gain compared to equities. So I've actually come to the end of the slides of my presentation today. So I hope you have actually, gained some insights into what's happening in the fixed income space, and also overall what is installed in the coming months ahead, so that equips you with more information to what you want to prepare yourself in the first rate cut of 2024, which is actually led by US for US market, the pivot. So back to you, Shane. I think we are going to the Q&A session, right? On this.
All right. Thanks, Michael, for your sharing about the route ahead for the fixed income market. So if you have any question to ask our speaker today, you may write them at the Q&A box, okay? So write them at the Q&A box. All right, so I've seen a couple of questions on my screen. So the first question is asked by Mr. Lim Cheng Xiang. So year to date, what is the total foreign inflow in the local bond assets? And what do they mainly invest in?
I think the last couple of months, we actually see more portfolio investors, especially the bigger portfolio global managers, have started to actually accumulate in terms of Malaysian government securities, of which bonds is one of the asset that they have interest in, because also, as you can see, because of the appreciation of the ringgit, some of these investors also, assets that they have accumulated benefited from the strengthening of the ringgit, which means that when they actually convert them into dollars, they actually get more dollars with their investments in ringgit bonds. So I mean, we can look at there has been some more interest and has been more demand coming through into the fixed income market from offshore investors. What's our view in terms of property bond, especially China? I think if you are into higher risk appetite and you think that you want to gain from a rebound in property bond in China, you may consider adding some in your portfolio, but I have to qualify that these are also very high risk because the execution of policies and in terms of addressing the current bearishness in the China property market has yet to be seeing a meaningful big turnaround because even very strong companies are also being dragged into this rather murky outlook of the Chinese property bond market. So will Malaysia follow with a rate cut? At this juncture, I think maybe not at this time, simply because we're done with the diesel cut subsidy, where in terms of diesel prices are actually now closer to market prices. We have not seen the impact potentially that could come through from RON 95, reduction in subsidy, which means that higher market prices for RON 95. So on that, I think in terms of inflation expectations for this year, official forecast is still looking at 2 to 3.5% for headline inflation, and then 2 to 3% for core inflation. But so far, the numbers that we've seen in terms of inflation is still hovering around 2, whether is it headline or is it core inflation. So even there's possibly a reduction in subsidies for RON 95, we don't think that there will actually be a huge surprise per se. And not to forget, we also saw the strengthening of the ringgit, which also addresses imported inflation. So with this, I think there will be some offsets when you actually see, RON 95 going up, but then also offset by strengthening of the ringgit to reduce imported inflation within the system.
So when do you see that is a reasonable timeline for Bank Negara to cut interest rate?
When they actually see a much turnaround, I mean, a downturn in terms of the GDP number, or because currently, I think for the past 2 quarters, GDP for Malaysia has turned on a surprise. I mean, the numbers were actually very strong, which actually means that growth is still quite resilient in Malaysia compared to our neighbors. So on that note, that's also why we have actually seen more positive flows or demand coming into the market for Malaysia, whether it's in stock market or in the bond market, because we have actually, in a way, done all the right things for market, good GDP growth, stable inflation, fiscal debt to GDP has also been fixed because lowering of debt, meaning lowering the numerator, and then we also have a bigger GDP that's been surprising on the upside over a bigger denominator. So fiscal debt to GDP will actually be on a downtrend in terms of that with the reduction in federal debt.
All right, thanks, Michael.
You
have something to add?
No, I will just take the cue for your questions.
All right, cool. We learned that the Malaysian ringgit has a sharp appreciation in the past month. So my question here is, will there be a scenario where investors invest in bonds, and because of this sharp appreciation of depreciation of a foreign currency or local currency per se, so will that result in a loss when we invest in the foreign denominated bonds?
Yeah, so there's always this risk that if you're investing on your own foreign bonds without hedging, that's where the expertise of the fund manager will come in terms of if you have a foreign exposure and if you are actually a ringgit-based investor and your home currency is the one that's strengthening, you need to have some hedging strategies that is being embedded in your portfolio. I mean, normally hedging is not done at the retail level. You normally need fund managers to actually express those hedging mechanisms in the fund. And why do we hedge is because we want to ensure that the income that we're getting, because they are not like double-digit returns unlike equities. For bonds, it's either 5 or high single digit return. Most of this return has to be protected with your currency movements as well. And that's where if you're investing overseas or you're investing in dollar bonds, you need to have some form of hedging to hedge off the FX risk. And typically, these are the ones that the fund managers will play an important role in ensuring that your returns are protected and not being affected, or rather being reduced by FX changes.
Yep. Thanks for clarification. So with that being said, we have a follow-up question by Hui Ya. So what do you foresee will happen to a dollar-denominated bond?
Dollar-denominated bonds, you will obviously see price gains in terms of reduction in when Fed cuts interest rates, lower yields in dollar yields translate to higher US bond prices. But you also need to be aware that if you are using ringgit from the initial point of investments, you need to ensure that you also hedge on currency, because your gain in US dollar terms, because of a cut in interest rates or because of yields generally move lower, because of high interest rates in the US, you need to also ensure that your total return is not being erased by foreign currency movements. So that has to be also something that you need to bear in mind when you're investing in US dollar bonds.
Thanks, Michael. The next question is by Eugene Wong. Are most of the MGS holders Malaysians through EPF? Is there reasons why young investors should hold bond? Because most of us already have exposure indirectly through EPF as opposed to equities, because we know that EPF have the largest exposure to bond market.
So why would young people hold bonds? Because most have exposure indirectly through EPF as opposed to equities. Yes, you're right, because in a pension fund, a bigger portion of their investments has to be in government securities and also has to be in corporate bonds, fixed income instruments, to ensure that you get to the stability of the portfolio from a strategic asset allocation perspective of a pension fund. So typically bonds, cash, they are actually a bigger part of the asset allocation of a pension fund. Whether young people need to ensure that they invest in bonds or relevant to them, essentially, it is also relevant for them, because if you want to diversify, you want to earn a return, but the riskier assets are giving you negative return, you will actually get potentially positive returns in bonds, because in an environment where riskier assets do not do well, growth is a bit more challenging. That's where you actually get gains from price appreciation of bonds, on top of the income that you're supposed to get from bonds. Yeah, so I think in terms of that view, it is also a diversifier, meaning to say that your overall risk in your investments is also carefully curated in that sense, so that you do not lose value in your investments. Yeah. Although you already have that expressed in EPF, but on your own, of course, when you want to take, you have gains in your equity market, you locked in already, where do you seek temporary, or rather some refuge from price volatility and all that, then typically we actually see that flowing into the bond market or bond investments.
All right. Thanks, Michael. So the next question is by Charlie Chan. Now, let's say that interest rate don't change and remain stationary. Will the price of bonds stay unchanged?
In terms of
what other factors affect the price of bond?
I mean, what will be the other factors that will affect price of bonds? If there's no change in interest rates, I mean, in terms of the you will still get returns from your income lah. At least you do not lose in terms of riskier assets, in terms of price adjustments or volatility, which you actually see more in the more aggressive asset, like higher risk assets. So you still benefit from getting the yield or the cash coupons or profit that you get every 6 months for your bond investments lah.
All right, thanks, Michael. Joey made a statement here, and would like to check with you. Now, since the Malaysian's GDP has improved, will this increase Malaysia's bond yield? And is it a good timing to invest in Malaysia bonds right now?
Yeah, so in terms of GDP, yes, Malaysia's GDP has improved and has also been very resilient in terms of the Malaysian economy. But having said, I think you still need to also invest in bonds, because if, let's say, there's a rate cut, when the global shift in terms of growth starts to be on a weaker side, that's when you actually potentially could gain from bond investments in the form of price appreciation. Not something that you can get from your fixed deposit, because fixed deposits are actually locked up returns with a fixed return at the end of maturity. But in an expression of interest rates, typically you can do that in government securities or in corporate bonds. So these are the things that becomes a bit more in demand in a downward shift in terms of the economy lah. But even though Malaysia's economy is doing well, there won't be a case where we will be hiking interest rates, because on a global basis, everyone is actually on the path of reducing interest rates. What it means is that for Malaysia, they can actually take their time in terms of reducing lah, because growth is still decent. Fiscal debt to GDP is still is improving because of a bigger denominator base in GDP. So all that actually works towards our favor. And you can also get possibly price gains, because if foreign demand is in for government securities, then you will actually see capital gains in the form of government bonds as well.
All right. So with all these economic landscape and the potential subsidies retargeting in the second half of 2024, how should you factor this downside risk to your bullish call on bonds? So that's a question by Sean Lim.
Sorry, could you repeat that again, Shane?
Yes. How do you factor this downside risk to your bullish call on bonds? When all this kind of economic growth and potential subsidies retargeting in second half of 2024?
How do you so I think you need to also look at yes, I mean, of course, if there's a cut in subsidies, which means there's a temporary increase in terms of inflation. But the thing here is we need to look at is these are actually cost push inflation. So cost push inflation, or in some sense because of adjustments in subsidies and all that, those are not really the factors that central bank that will look at in terms of having a shift in terms of monetary policy. Cost typically is they will wait for these costs to adjust in the economy. Then, I mean, they won't be actually increasing interest rates to address that scenario, because if they increase, then there will be a double whammy. That means you have to address on costs push inflation, your prices of fuel has gone up, and then you add interest rate. That means it will double burden for the rakyat. In those episodes, we don't think that if it's a cost-driven factor in terms of inflation, will make the central bank into increasing interest rates. At most, it will actually maintain the current interest rates until the inflation dissipates. just like any adjustments, whether is it GST, imposition of GST, or reduction in subsidies, there's always this few months of seeing high inflation going higher. But after that, what the more concerning point that we normally have to look at is whether there are second round of inflation effects, where it translates into a demand-led inflation. But if it's purely on cost push, the monetary policy response to that is not by an increase in interest rates.
Thanks, Michael.
Mm.
GLICs are increasingly shifting its investment domestically. So what would be the impact to the local bond market that you foresee?
GLICs that will be investing more domestically, and then how will that impact in our local market, is it, Shane?
Yep.
Yeah, so that's why we've actually seen tightness in spreads for corporate bonds, because everyone is looking into investing domestically. So if you are invested in a bond fund, which is a year ago, definitely this year you have made some handsome or decent returns in terms of your portfolio, because demand has actually outweighed supply. So far this year, supply for the bond market generally has been quite on the low side. So when we have a bigger factor on demand versus supply, that actually translates into higher bond prices because of captive demand. There's very strong demand going very few papers.
Thanks, Michael.
Mm.
Now, having talked about bond funds, right? So Steve's question is, between corporate bonds and bond funds should have much lower risk, right? But how about
Yes.
returns?
Yeah, so if you own direct bond, unless you're very sure of a particular issuer in terms of its credit profile and repayment potentials, and a bond fund, you actually have a more diversified holdings in terms of spreading that risk across more issuers, and that will actually reduce the credit risk of your investments in a portfolio. Because if you buy direct in one particular bond, essentially you are exposing to 100% of its risk. So what a bond fund allows is to ensure there's sufficient diversification, whether is it by sector or by even within fixed income, there's government securities and corporate bonds. Whether are you also enabled in that those two investments, and then issuers, whether is it bank issuers, corporates, whether they are in infrastructure, property. So a well-diversified bond fund will actually gives you better risk-adjusted return than a single bond as a particular investor.
Thanks, Michael. The next question is by Kawai. So on average, how frequent does a Malaysian bond issuer defer their bond coupon payment to investors every year?
So it's uncommon for a Malaysian bond issuer to defer their coupon payments, because deferring of coupon payments means their repayment capacity or their profile to pay is weakening. So those are the issuers that you should stay away from. And if they are deferring, then it means their outlook looks a bit bleak. Either they get restructured or refinance their debt obligation. On average, I think these are actually not common at all for Malaysian to defer their coupon payments. Usually when they defer, typically they are in a weaker position. And that's also when bondholders or sukuk holders come together to actually see what are steps to be taken for those issuer that is in this dire situation where they defer coupon payments. Yeah.
All right.
Not common at all. Yeah.
Yeah, not common. So we have a very good credit rating.
We'll look at the, typically the expression or capacity to pay is rating is one information, but I think you also need to have a full credit assessments before you actually embark into a corporate bond investment.
So when you evaluate corporations who issue bonds, right? I suppose their balance sheet, their solvency level is of a superior, must be of a superior standing before you invest in it, right? The
There
cash
is always categories to it. You want superior balance sheet, superior P&L. Typically, those are their very safe
investment grade bond.
investments. So they are like your triple A, right? Generally, I think investors prefer also not just in the super safe, but they want to take moderate risk kind of investments. They can look at for example, double A, three, or single A investments as other investment options as well, because while these numbers or balance sheet, they not as strong as a triple A, but they reward you by having a higher yield or a higher coupon in terms of your investments lah. So not to say everyone will just look at triple A, but there are also some investors or some high net worth individuals that want to have a higher coupon or higher yield as one of their fixed income investments, Shane.
Yeah. So just now you mentioned that the supply was scarce, right? I mean, it's
Mm,
scarce.
mm.
Do you refer to the government bonds or the corporate bonds?
Both.
Both are okay. Both are
Because corporate
scarce.
bonds, there are also not as many issuers compared to the global space. So demand is quite strong because everyone is actually looking into the Fed pivot or the Asian central banks pivot. So demand for fixed income as a strong asset class is still is very relevant. And then government securities, because for example, like Malaysia, we're also reducing that in the form of fiscal consolidation, which also means that there's actually less issuance of government securities supply coming to market. And that is also when yields are actually more resilient. And if there are lots of maturities in government bonds, for example, this year or next year, that will also increase the demand because when these investors get back cash upon its maturity, they need to reinvest this amount into other bonds. But if let's say it's tight supply coming from the government bond market, then you actually see price increase in government bonds as well because demand outweighing supply.
Thanks, Michael. So the next question is by Seng Fu. How risky are triple B bonds?
Triple B in Malaysia, generally, they are slightly higher risk, but actually in Malaysian fixed income market is not very common. But triple B in the other overseas market, it's quite common. And generally, they are quite decent issuers lah. Triple B by international standards is actually pretty decent issuers lah. I mean, case in point is actually Indonesia. Indonesia is a triple B country. So we don't think that Indonesia will be defaulting on its debts. So for an example, triple B in this case in the global rating scale is actually quite a decent investment. I wouldn't say it's super safe, but it's also not to say that it's the high risk. Anything that is below triple B, like a double B and single B, those are the ones that actually has a higher risk in terms of investments.
So when you mean Indonesia bonds are triple B, do you refer to their government bond?
Yeah, Indonesia is a triple B in terms of government bond, correct.
All right. So what is Malaysia's rating for Malaysia MGS?
Malaysia rating by Moody's and S&P is single A. So those are the ratings that is for Malaysia lah.
Slightly better than Indonesia at the moment.
It has always been better
okay.
than Indonesia lah for in recent time. Yes. Yeah.
So there are still some questions on my screen. So let's do this as a last question.
Sure.
Michael, can you talk about inverted yield? It has been inverted since the US raised the interest rate.
Yes.
So what does it mean by inverted yield? And apparently, is it when the yield flips is when we get the recession?
Yeah, so actually this inversion in yield curve has been happening for quite some time, since 2022 to right now. Essentially, the expression of a inverted yield curve means that Fed will be, cutting interest rates in the future, and that's why people are, buying long-dated debt to express that strategy or that outlook, because they don't think that Fed can continue increase interest rate forever. So when an inverted yield curve to a fixed income investors, what it means is there is a slowdown that's coming, which is already quite apparent when we talk about inverted yield curve for the longest time. So usually what happens is that when there's an inverted yield curve and really is slower growth that's coming in the near future, it is always it's always in tandem with a rate cut. So if there is a rate cut that eventually materializes, short-term interest rates will be the sensitive one, which they will actually respond to a cut in official interest rates by lowering of yields. So on that, actually, it also means that your short end of the yields will also go lower, which means that the inversion over time will also adjust to a flat yield curve, which means that typically there's less growth or economic landscape is a bit more challenging. So inversion is, we've seen something, what we've seen in the past, but actually now we will probably see a reduction in short-term yields for short-term bonds and eventually see a flatter yield curve.
All right. So thank you so much, Michael, for doing this segment for us. Hope that all of you here have learned a great deal about bonds and fixed income today and what is the outlook like for the fixed income market. So thank you so much, Michael.
Thank you so much, Shane, and everyone for joining, to spend this time, with us, and hope everyone learned something from today's takeaway.
Yep. So ladies and gentlemen, you just listened to the Chief Investment Officer of RHB Asset Management, Mr. Michael Chang. Thank you, Michael.
Thank you, Shane. See you again. Bye.
Yep. See you.